In this video, I want to share some quick updates on a few stocks in the YouTube portfolio. For those of you who may be new here, the YouTube portfolio is a challenge I started on my channel to see if I can outperform the S&P 500 over the long term. I follow this portfolio and its holdings here on the channel, and keep you up to date with how I am performing and what I own in the portfolio. So far, this portfolio is up 51% versus the S&P's 28% since I started it, so I'm happy to say that I have been outperforming so far. And again, in this video, I am going to cover some key updates with some of my stocks, and I am going to try and rapid fire this video as there is quite a bit to cover. So let's get right into it by starting off with Fortinet. Fortinet recently put out a new investor presentation, and this slide right here from the presentation shows that Fortinet's TAM is projected to grow to $199 billion by 2027, which is a 12% compounded annual growth rate. Fortinet also operates in three main industries, which are universal SaaS, security operations, and secure networking. This next slide shows the growth to these industries, and here we can see that secure networking is projected to grow by 9% annually. Security operations is projected to grow by 14% annually, and universal SaaS is projected to grow by 20% annually. So security operations and universal SaaS are projected to grow by double-digit growth rates. Now what's interesting about this is that Fortinet's largest market is secure networking, and this is the one that is projected to see the lowest growth. We can also see that secure networking makes up 70% of Fortinet's business today. So the other smaller segments of Fortinet's business are most likely to continue growing into larger and larger segments, as these segments' TAMs are expanding at almost double the growth rate, if not more. These other segments are where a lot of Fortinet's growth will most likely come from over the next 5 years. And it's also partly why I think Fortinet will continue to grow at 10% plus annually over the next 5 years as well. Additionally, Fortinet is the second largest player in the cybersecurity industry. Its revenue growth has also been above the average within the industry, despite it being one of the largest businesses. Fortinet says the industry is currently fragmented and is ready for consolidation. This basically means that Fortinet is looking for acquisitions, which could further boost the company's growth and give it a larger percent of the overall cybersecurity market. Fortinet is still trading for a price to free cash flow of 22 today, which is a free cash flow yield of roughly 4.4%. This is still lower than the company's 10-year average price to free cash flow ratio of 27, so the company does still look like it is selling below its historical averages and could be selling below its fair value. People are currently worried about the business's current revenue slowdown, but when you zoom out, this business has a history of incredible success and growth. So I think that Fortinet will continue to grow over the long term, and eventually, I do see its valuation going back up near its historical averages. So its multiple expansion plus its future growth, I do think will offer outsized returns over the S&P 500 over the next 5 years. Now, moving on to the next stock. This one is Brookfield Corporation with a ticker symbol BN. Brookfield is my largest position and a stock that I talk about quite a bit on the channel. So I am going to share some recent updates and news that I found, as well as some of the business's key assets that I have not discussed before. Brookfield provides critical water and sanitation services to Brazil. It is one of the largest private water distributors in the country and provides water and sanitation to more than 15 million people in over 100 cities. Brookfield also owns a natural gas pipeline that accounts for more than half of Brazil's natural gas demand, which is massive. Recently, Brookfield also purchased $2 billion worth of India's telecommunication towers from American Tower. This has led to Brookfield becoming the largest operator of telecom towers in India, at the same time as demand for data is booming in the country. These assets show you that Brookfield is very much a global investor and owner of critical infrastructure which economies rely on. The necessity of Brookfield's assets ensure that they will continue to perform well over the long term, maintain and grow their value, and produce consistent cash flow for years, if not decades to come. Brookfield is projecting a 22% compounded annual growth rate to its free cash flow by 2028, which is $10.3 billion in free cash flow for the year of 2028. Additionally, Brookfield is projecting to produce $43 billion in cash over the next 5 years. On a market cap of $61 billion today, This means that Brookfield will generate 2/3 of its current price in cash over the next 5 years. Also, this means that if the business does hit its projections for 2028, then it is selling for 6 times 2028 cash flows, which I think is still an attractive price for me as a long-term investor, and is one of the reasons why I am happily continuing to add more Brookfield to my portfolio, even though it's already the largest position in the portfolio. All right, moving on to stock number 3, which is Equitable Bank. This is another large position in the YouTube portfolio with a 12% weighting now. It is also one of my largest gainers, being up over 50% on the entire position now. Equitable Bank recently was hosted at the RBC event and spoke more about their business, its plans for 2024, and its price today. I went through the transcript of the event, and here are all of the highlights that I found. Here is our value creation methodology. We generate about a 15 to 17% return on equity. We pay out about 10% of that, or 1% of our capital, as dividends every year. Dividends growing at about 20 to 25% a year, but still not a high yield compared to other banks. That leads to book value per share growth of 14% to 16% and earnings per share growth of 14% to 16% as well. You take all of the banks listed on the TSX and the S&P 500, look at the total shareholder return over the last decade at this point, with the top of the stack in that regard. This is not because of multiple expansion. This is because the book value per share has actually grown at 14.9% compounded annually over that period. So this explains Equitable Bank's value creation methodology. Basically, the bank generates about a 15 to 17% return on equity, and then they only pay out 10% of their earnings annually as a dividend. This is also why Equitable Bank's dividend yield is lower than a lot of the other banks, because they pay out roughly 50% of their net income as a dividend to their shareholders. What I also love from these paragraphs is the CEO says that Equitable Bank's strong historical performance, the share price performance, didn't come from multiple expansion. It came from the underlying fundamentals of the business growing. And this is something that I talk about a lot here on my channel. I urge investors to understand where the historical returns of a stock has come from, because over the past decade, a lot of stocks have seen high returns due to their multiples expanding significantly, and not as much due to the fundamental growth of the business. Equitable Bank is not in that scenario though, and we can explain why by using stock analog. So here I have Equitable Bank's diluted earnings per share, price to earnings ratio, and its stock price charted over the past decade. And we can see that the company's earnings per share has compounded at 14% annually. However, its price ratio has actually declined by 0.4% annually. So the price to earnings ratio of this business over the past decade has not grown at all. However, we can see that the stock has compounded at 13.36% annually. So the share price returns are entirely coming from the earnings per share growing, or the underlying fundamental growth of the business, and not due to the price to earnings ratio expanding. This means that Equitable Bank's strong share price performance is not due to multiple expansion or the stock simply becoming more expensive. I love to see this. But let's move on to the next screenshot here. And this says, you might have seen these returns and said, well, it's all over, I missed it. If you did indeed miss it. But I'm not a committee story at all. In fact, when you look at this kind of conventional way of value in banks in terms of kind of regressing ROE to price to book, you can see that the value to date could be $136 is fair value. We trade just shy of $90 as we speak. So I think there's going to be an opportunity on the upside even to kind of correct that close, that gap. And then, of course, hopefully, we can compound the returns of 15% as we have over the last decade in the years ahead as well. So the CEO believes that the fair value of Equitable Bank is $136 per share based on how the other banks are valued, and that Equitable Bank is still selling for a discount. Now what's interesting is in my own discounted cash flow calculation, assuming a 15% compounded annual growth rate to the earnings and a 10 price to earnings ratio, I get a fair value of $134 per share, and a compounded annual growth rate of 19%. So this is pretty close to what the CEO believes the fair value of the stock is today as well. But moving on, this says, but we do run a very lean operation. As you mentioned, we don't have any branches. We don't tend to fly, and we don't fly business class. We do kind of keep things under control. There's not many millions of dollars that can be cut out of some meals and entertainment types of expenses. So Equitable Bank is running a very lean operation. They have no physical branches to maintain, and the employees do not fly business class or spend money on luxurious hotels and travel. This kind of thinking and culture reminds me of Constellation Software, and how Mark Leonard would fly economy and not business class when he was CEO of the business and it was a multi-billion-dollar business. Equitable Bank seems to have that same kind of cost-saving culture. Moving on, the analyst asks the CEO and says, "Are there numbers you can kind of give around how much you want to be spending in 2024 in terms of increasing that brand awareness?" Then the CEO says, "We're looking to double our spending on brand awareness this year." We also think about what they're doing to the cost of customer acquisition. So we have a metric in mind of what we believe the value of a new customer is, and we try to be operating at about 1/7 of that as our cost of customer acquisition. And we really focus on Net Promoter Score. In fact, we put Net Promoter Score as one of our key metrics at driving executive compensation. We need to make sure that they have a very positive experience with us, so they promote by word about the EQ Bank is a place to the bank. So there's a little bit to unpack here, but basically Equitable Bank is starting to double its marketing spend this year, and what I love is the company wants to acquire customers at 1/7 of their estimated lifetime value. This means the business will not spend money on marketing if it is not returning a significant amount of profits to them and they're getting a strong return on their investment. So they are hyper-focused on profitable growth and not wasting money just to spend it. Equitable Bank also uses their Net Promoter Score as one of the key metrics for executive compensation. Net Promoter Score is the likelihood of a customer recommending your business to their friends. This means that Equitable Bank rewards its executives based on how likely customers are to recommend EQB in the future. All right, moving on to the fourth and final stock, we are going to quickly discuss Lumine, which has grown into a large position in my portfolio all on its own. This stock is one of my largest percent gainers as well, returning over 80% now. There's not a lot of investor data on this business, so whenever I see some new information, I do try to share it with you here on the channel. I saw a tweet from Pedro Garcia last week, and they said that they had a conversation with Lumine's CEO and shared some of the highlights from that conversation. So here it says, 4,000 companies in the database, only mission critical and highly recurring. Bigger targets than Constellation Software and Topicus on average. He thinks he can grow at a faster rate than Constellation Software and Topicus as well. Organic growth will be as high as Constellation Software and Topicus. So Lumine expects its acquisitions to be larger than Constellation Software and Topicus. In fact, on December 20th, Lumine announced an acquisition of a device management company from Nokia. The purchase price of this business was up to 185 million euros, which is larger than the typical acquisition size of Constellation and Topicus as well. This means Lumine could potentially deploy even more capital than the other two businesses, and when it does do acquisitions, they should massively increase Lumine's growth. So Lumine may not do as many acquisitions, but when it does, they are probably going to be bigger and more significant. Lumine also says that it has over 4,000 businesses within its acquisition pipeline, so there is no shortage of businesses to acquire, which suggests that the business does have a long runway for future growth. The stock has run a lot recently, and I honestly don't think that it is very cheap anymore. I actually think that it is selling above fair value now. So I'm not eager to add more to my position, but again, if the stock does come down, then I would happily buy more of Lumine. But that is going to wrap up the video for today, everyone. And let me know down in the comment section if you did enjoy this kind of video, where I just give you a quick update on some of the news around some stocks within my portfolio and some of my top holdings. And if you did, then please remember to leave a like on the video as well. But that is going to be all from me for today. And thank you all again so much for watching. I truly do appreciate it. And I really hope to see you all again in my next video.